Every hour of every day, a government facility in Washington, D.C. turns plain paper into money. To keep up with demand, these machines run nonstop, pumping more than $500 million into the U.S. economy every single day. But this is only a tiny fraction of how much money is actually created. Most money today doesn't exist as cash at all. It exists digitally, and that number increases by more than $4 billion every single day. So where does all of this money really come from? Before it ever reaches your bank account, it changes hands countless times, passing through people, governments, and businesses, all after being typed into existence on a computer. We modeled the entire system to show how money really works, how it drives the economy, inflates prices, and ultimately pulls people into debt. But to truly understand how we got here, we need to go back to a time before money even existed. Thousands of years ago, if a farmer needed a new tool, he would visit a local toolmaker. The farmer didn't have anything to trade immediately, so instead, they agreed on something simple. The farmer owed him value in the future. The toolmaker trusted the farmer, and that promise of future value became an acceptable form of payment. 2 weeks later, the farmer returned with food from his farm. The debt was settled. Over time, people realized that trading promises wasn't always practical. To make transactions easier, societies began using commonly needed items like cattle, grain, and salt as payment. These things had value because everyone needed them, and they weren't easy to obtain. Now the farmer could buy a tool and pay instantly using a specific amount of grain. Transactions became faster, simpler, and more reliable. But as trade expanded, carrying bulky goods became inefficient. Eventually, societies settled on metal coins made of gold and silver. They were small, durable, and extremely valuable. This changed everything. Trade exploded across continents. Goods were bought and sold from China to Europe, but there was a problem. Transporting large amounts of gold was heavy, slow, and dangerous. That's when the idea of money began to change. In 17th century London, trusted goldsmiths started offering a service. People could store their gold with them for a small fee. In return, they received a paper note promising they could retrieve their gold at any time. That piece of paper had no intrinsic value, but because it could be exchanged for gold, it became just as valuable. Soon, people stopped trading gold altogether and simply exchanged these paper notes instead. Then the goldsmiths noticed something important. Most people never came back to claim their gold. So the goldsmiths began issuing extra notes and loaning them out, charging interest in return. This new money wasn't backed by any additional gold. It was created out of nothing. If a goldsmith loaned out the equivalent of 100 gold coins, he didn't lose anything. He simply wrote a note worth 100 coins. When the loan was repaid with interest, he ended up richer than before. From a single loan, the total amount of money in circulation increased, even though no new gold was created. The system worked as long as everyone didn't demand their gold at the same time. Replace goldsmiths with banks and paper notes with digital numbers, and you have today's financial system. Modern banks don't store piles of cash waiting for you to withdraw them. The numbers you see in your bank account are promises. They represent debt. When you deposit money, the bank owes you. Loans work the same way, but in reverse. When a bank gives you a loan, it doesn't hand out existing money. It creates brand new money by typing numbers into your account. That money didn't exist before the loan, and when you pay it back, the money disappears. The bank keeps only the interest, but while that money exists, it fuels the economy. You buy a car, the dealership pays employees, they spend that money elsewhere. Businesses grow, jobs are created, technology advances. None of that would happen without new money entering the system. The problem is, productivity doesn't always grow at the same pace as money creation. When more money chases fewer goods, prices rise. This is inflation. To control this, banks are supposed to limit how much money they create. In the past, they could only lend a portion of the cash they actually held. Today, that restriction barely exists. If banks need more reserve money, they simply turn to the central bank. And this is where the system becomes even more complex. To create new money, governments issue bonds, which are essentially loans. Banks, corporations, and even foreign governments buy these bonds. The money raised is used to fund government spending. That money flows through the economy and eventually ends up back in the banking system. The issue is that governments consistently spend more than they earn. When tax revenue isn't enough, more bonds are created. Debt increases, and the cycle repeats. In a single year, government spending can reach nearly $7 trillion, far more than taxes can cover. The gap is filled with debt, paid for by future taxpayers. As strange as it sounds, this debt-based system is how most of the world operates. It isn't inherently broken, but is far from efficient. If newly created money were directed toward productive investments like infrastructure, education, and innovation, the long-term benefits could outweigh the costs. Instead, much of it fuels debt, speculation, and rising prices. And that's how money, something we use every day, is created, multiplied, and ultimately becomes a force that shapes entire economies and individual lives.